Hello, this is Paula, your instructor for Accounting 500. Today I'm just going to give you a very basic introductory presentation on break-even analysis. If it's new information to you, then it'll be helpful. If you've been using this in your career already, then it might be a little bit too elementary for you. But I need to get this out to you all, and hopefully it helps someone. So break-even analysis and introduction. Basically, we're going to compare briefly accrual accounting and its characteristics to CVP, cost volume profit analysis. Under accrual accounting, sales is variable, obviously. If you buy one unit, if you go to Costco or Walmart and buy one bottle of water and it costs $2, it's going to be $2. If you buy 10 bottles of water at $2 each, you're going to be paying $20. The variable cost per unit is fixed, but it's variable because it is dependent on how many units are sold. So the number of units times the sales price per unit. So sales, by definition, are variable. Cost of goods sold. We have had a couple mods already dealing with cost of goods sold, so we really know that we have direct material and direct labor. Those are variable. Then we have manufacturing overhead, which we allocate either to the actual units that we produce, which would be more like full absorption costing, or we will just expense it off, and that would be more variable costing. Either way, the majority of the cost inside of manufacturing overhead is fixed, and that's why we call it fixed manufacturing overhead. So cost of goods sold from the accrual accounting, the variable expenses will go over to the variable costs under the CVP income statement, and the fixed will go down to the fixed cost in the CVP income statement. So the accrual accounting says sales minus cost of sales gets you gross margin. CVP says sales minus variable cost gets you contribution margin. Contribution margin is the income that contributes to covering fixed costs. And when fixed costs are totally covered, it becomes profit. We are going to ignore taxes at this stage of this presentation. Operating expenses under accrual accounting have a variable and fixed component to it. Sales salaries. You usually pay salesmen a base salary, which is substantial, which is substandard living, and then they get commissions based on how much they actually sell. So the commission part would be variable, and their draw would be fixed. So there's other examples inside of operating expenses that are variable and fixed. However, let's keep this a short presentation. Variable goes up to variable expenses, and the fixed goes across to fixed expenses. So we're not eliminating expenses. We're not taking only bits and pieces of the accrual accounting income statement. Basically, in both methods, pre-tax income is the same as profit in both methods. So that's what this equal sign is about. So in my area of the country, McDonald's has been running a $1 large drink promotion. Now, I'm going to make an assumption here that McDonald's only sells one product, and that product is beverages. So in this case, sales is $1 per unit. Variable costs, I'm estimating at 30 cents a unit, and that includes the cost of the cup, the cost of the little plastic lid, the cost of the straw, the water. If it's a soft drink, the cost of the fountain mix, and if it's, in my case, iced tea, is the cost of the tea, plus the 3 lemons I always ask them to put in. So those are my variable costs, and they average 30 cents per unit in this example. So the contribution margin is 70 cents per unit. So every time a car drives through the drive-through and gets one drink, each drink carries with it 70 cents of a contribution margin. 70 cents will contribute to covering fixed costs until the fixed costs are covered. And then when fixed costs have been covered, then contribution margin will fall straight to the profit line. In this example, we also have fixed costs of $20,000 a month. So how can we calculate break even? Break even is defined as fixed cost divided by contribution margin per unit. So in this example, fixed cost is $20,000. Contribution margin is sales of $1 minus variable cost per unit of 30 cents. So 20,000 divided by 70. And that equals 28,571.42 units. Okay, let's say 28,572 beverages. So does it break even? So let's test it. Does our profit really equal 0? Sales would be $1 per unit times 28,572, and that gets you 28,572 revenue. Variable cost is 30 cents times unit sales of 28,572, and that's 8,572 variable cost. So 28,572 revenue sales minus variable cost of 8,572 equals 20,000 minus fixed cost of 20,000 gets you profit of 0. So woohoo! Our break even equals 0. But do we really want to make 0 profit? I don't think many business owners are happy making no money. So let's start a homework example. Just for this presentation, we have Jackie, and she owns and operates a restaurant, and she has fixed costs of $24,000 a month. She serves luncheons and dinners. Her average bill, excluding tax and tip, is $21 per customer. This is the bill that she presents to the customer, which would be basically her revenue per customer, $21. And her present variable costs average $10.60 a meal. So what is the break-even point in numbers of meals served per month? Well, break-even units is fixed cost of 24,000 divided by contribution margin, which in this case is $21 per customer for sales per unit, and the variable cost is $10.60 per meal. So she's making $10.40 contribution margin for each meal served. $10.40 divided into 24,000 gets you 2,307.69 meals. Let's say it's 2,308 meals to break even. She's not happy. You just told her she has to serve 2,308 meals a month to make absolutely no money. She wants a profit of $8,750 a month. So she's asking you, what does my volume have to be? So how can we adjust the break-even equation to accommodate a profit goal? Well, let's look down here. Hint, To forecast profit, use the following equation. Fixed cost divided by contribution margin per unit is the same equation that we've had before. This time we're just figuring out fixed cost plus profit goal divided by contribution margin per unit. So how many meals must she serve to attain a profit before taxes of $8,750? She has to serve 3,149 meals. Fixed cost $24,000 plus profit divided by the $10.40 we calculated up here, and that will get us 3,149 meals. I hope this has helped, and I'll talk to you some other time. Thank you.